Good morning, folks. Your Monday morning to discuss tax. I suppose the timing is very good, though, because we are reaching the end of the financial year, and I'm sure many of you would be liable for tax pretty soon. So before I start today's session, I do just want to reiterate, this really is about the basics and managing your small to medium-sized business tax efficiently. Please know, there is a huge difference between tax efficient or tax avoidance and tax evasion. Okay, so evasion is illegal. We can avoid tax by managing our businesses tax efficiently. So let's start off the morning by looking at our basic income statement. So I'm sure you all know that we get income from our trading activities. There are cost of sales elements, and that gives us gross profit. Then we have operating expenses, the costs of running our business, which gives us EBITDA, which is earnings before interest, tax, depreciation, and amortization. For the people that attended the lockdown sessions in March, April last year will remember that I did discuss these things with you. EBITDA is operating, also known as operating profit. We can then deduct our depreciation, our interest paid, and what we are left over with is profit before tax. So you all know any business that makes a profit is liable to pay SARS tax. And the amount of tax that you owe SARS is 28% of the profit that you show. Realistically, we probably and effectively, you will probably pay a little bit less than 28% on the dot, because there are tax tables that are published by SARS. There are allowances that are made, just like there are allowances made in our personal tax capacity. So you probably will pay a little bit less than 28%, but that's kind of the point I want to make, is that you're going to pay you're going to pay tax on any profit that you show. If you show no profit, you don't pay any tax. So let's have a look at where are the places that we can save on paying tax or be more savvy in how we account for this. So in order for us to do our taxes well, it's important to remember what the general accounting practices are. So when you study accounting and you become an accountant or a CA, the first thing, or one of the things they teach you, is generally accepted accounting practices, also known as GAAP. GAAP is literally 2 or 3 thick books full of rules and regulations. For our purposes, we are going to simplify general acceptable accounting practices into 7 factors. And if you remember these 7 factors and you stick to the 7 factors, you'll always be within the law when it comes to tax. Okay, so even though these are accounting principles, they apply very much to the tax legislation and tax efficiency as well. So the first thing I want you to remember is, if you are accounting, if you put information into your books, into your system, make sure that whatever you are doing is relevant to your business. If you run a plumbing business and all of a sudden you're deducting the cost of venue fees, just as a stupid example. If I was an auditor at SARS, I'd be asking questions around how's venue fees relevant to a plumbing company? For my business, which is a training business, venue fees are relevant. So make sure that whatever you are putting into your accounts is relevant to your business. Because if it's not, that's the first place an auditor will look and go, wait, something's funny here. Okay. Make sure that it's true. And what I mean by true and complete go together. Okay. something is true if there is evidence that it happened or that there is evidence that it is relevant to the business. Okay. So if you're deducting expenditure to pay less tax, keep in mind that if you don't have the evidence, if you don't have the invoice or the slippy or the piece of paper that proves that this deduction is relevant, true, and reliable, you're going to end up in trouble. Okay, and then make sure that whatever you are doing from a tax point of view is timely, because what you don't want to do is end up being late with your taxes and then you pay fees and fines. The fines are massive. In fact, the fines work out so high. And when I talk about these fines, I mean the monthly PAYE and UIF payments, the bi-monthly VAT payments, the annual and biannual company tax payments. The moment you are late with your submissions and your payments, the fines are massive. And the interest that they charge on the non-payment is even higher. So make sure, just as a start to this morning session, make sure whatever you do in your financials are relevant and true and complete, and then timely. So don't do any late payments. It just costs money. Okay, so that's our little income statement. So we know whatever happens at the top here affects the profitability at the bottom. So if we manage this in order to pay less tax, we need to be able to increase our expenditures to make less profit. Okay, that's how we become more tax efficient. So remember that your income statement is exclusive of VAT. So we're not going to talk about VAT today, value added tax. All the numbers that we look at today is excluding VAT, because VAT is not your money. You have to manage your VAT effectively to also save tax on that side of the business. But for your income and expenditure, and in order to determine your company tax that is payable, we don't look at VAT, and we're not going to include VAT in today's section. Okay, so let's start at the top and look at our income. So remember, every single rand that you generate as an income is liable or is taxable. Income doesn't just have to come from trading. Income doesn't just come from you buying and selling and offering your services. Income can also come from interest that you earn in your bank account, or maybe your business has a savings account or a call account where you put some money aside. So all that income is taxable. So keep accurate records, because all your income is taxable. Cost of sales is tax deductible. So the full value of the money that you spend to buy the stuff that you in turn are going to resell or that you're going to use in the jobs that you do is tax deductible. So keep accurate records. Do regular stock counts, because if you lose stock, guys, and even if it is 6 fittings that has gone missing between this job and that job, and it's 6 fittings that you can't invoice your clients for, that's 6 fittings that could be deducted to reduce your profitability to pay less tax. And not only is it good for not paying less tax, it's also good for keeping your business or managing your business better. Because if you know and you are aware of stock losses or things that go missing, you can also manage your cash better. Okay, so keep accurate records of your stock, your inventory, anything that you've put into cost of sales. And the best way to do this is to do regular stock counts. And remember, if you're going to deduct stock losses, so you've lost stock for whatever reason, somebody's stolen it, a box fell off the back of your bakkie, you need proof that that stock went missing, and you're not just cheating the book. So remember, true and accountable. Okay, so you need proof, which in the case of stock would typically be counting sheets. So if you do your stock counts, you realize based on what there should be and what there really is that there's a box of fittings missing, it should indicate on your counting sheet. And you need to keep that proof of stock losses for 5 years. Okay, so the important thing with managing your cost of sales figure as a tax deductible expense is obviously exactly what you are selling that is deductible. But if you are losing stuff that you're not able to claim from clients, you're going to need proof. You can't just say to SARS if they audit you, oh yeah, but that thing fell off the back of the bucky, so I couldn't. Doesn't work like that. Okay, you need proof. So if something was stolen and you want to write it off, you're going to have to go to the police station and tell and do an affidavit or open a case that says the following items have been stolen. Okay, so you can deduct stock losses, but you have to have the proof. And what basically happens is the moment you've got a stock loss, your cost of sale is going to increase. And if this increases, your profitability will decrease, which will give you less profit. Less profit means less tax. Okay. I'm going to skip operating expenses because there's a lot of information that we can share there. So I quickly want to talk about depreciation and interest as tax deductible expenses. Okay, so let's do interest quickly because that's easy. So the interest, all of us pay interest in some form or another in our businesses. Okay, either you've got an overdraft facility that you pay interest on, maybe you've got a bank loan, or you've financed one of your vehicles. All of that has interest attached to it, and the moment you start paying interest, that interest is tax deductible. So make sure you account properly and that you don't leave any of these interest expenses out of your tax deductibles, because if you don't account for the interest here, you're going to, it's going to affect this profitability. Okay, so remember that businesses pay interest earned would typically be part of your income. In a business, that interest is taxable from cent number one. So all interest earned in the business is taxable. As an individual, as a business owner, you can have investments or savings accounts where you can earn interest of up to 27,000 Rand a year before it becomes taxable. So you can actually, in your personal capacity, earn interest and dividends up to 27,000 Rand a year before it becomes taxable. Okay. Let's talk about depreciation. So I'm assuming that you guys know depreciation is the reduction of economic value over a period of time as determined by SARS. So every year, SARS published depreciation tables where they give you an indication of over which amount of time do we have to depreciate our assets. So an asset that depreciates means it's an asset that will be in the business for more than one accounting period. So we're going to use that asset for a year or more, at least. It has a value to the business, and we're not buying that asset for resale. And that's the difference between cost of sales or current assets and non-current assets, the big things that stay in the business, okay? And big things depreciate. So SARS published these tables as a rule of thumb. Electronic equipment depreciates over 3 years. Most assets depreciate over 5 years. Fixtures and fittings that are stuck in the business, like alarm systems, freezers, air conditioners, things like that, depreciate over 10 years. And if you own a horse, maybe you use a horse to draw the cart that you visit your clients with, horses depreciate over 4 years, just for interest's sake. Okay, so as an example, if you had 100,000 Rands worth of assets in your business, the assets depreciate over 5 years, that's 20,000 Rand a year. So monthly, you'll be able to deduct 1,666 Rand per month as a tax deductible expense. Okay, so I just wanted to, sorry. I should have fixed up this number to be the same as that number, but just as an example. So our assets depreciate over 5 years, most of them, electronic goods over 3, and then we can deduct this value on a monthly basis. So that $1,600 is actually quite a lot in order to reduce profitability before we start paying tax. So as a rule of thumb, make sure that all your assets are allocated that you can depreciate. Okay. Very importantly, SARS do give the following allowance to small businesses. Small assets, which are less than 7,000 Rand, can be deducted as operating expenses. So actually what we are doing is we are depreciating that small asset one shot. So for example, if we were to buy, so we've got some 40,000 Rand here, we go and we buy an asset of 5,000 Rand. So instead of deducting and putting the asset to our non-current assets and depreciating it over 3 or 5 years, we deduct that 5,000 Rand as a small asset, one shot in our operating expenses. So look what it does. So we go from 40,000 Rand operating expenses to 45,000 Rand operating expenses. And in this example that we've been using, it actually then gives us a loss. So many businesses have been known to spend some money on small assets during February or during the last month of their financial year. So I used to do quite a lot of work in the farming community, and this time of year, farmers buy tires for their tractors, tires for their cars, tires for all the vehicles that they use in their farming practice. Because if you are spending less than 7,000 Rand, you can quickly up your expenses, reduce your profitability, and that impacts your the amount of tax that you're going to pay. So it's an asset that you would have bought anyway. You don't go and buy fancy things now just to pay less tax, okay? From a business management point of view, that's not a good principle to follow. The idea here is to say, okay, we were going to buy something that we needed anyway. Let's say a compressor. I needed a compressor for the business. So it's tax year. I see I've made a little bit of a profit. I've got a bit of cash in the bank, so I can actually afford to go and buy the compressor. Let me buy the compressor now and deduct it one shot. So I put it into assets, small assets, deducted as an operating expense. It reduces my profitability. I pay less tax. Okay. Please, guys, from a business management point of view, don't go out now in February and go buy a whole bunch of junk that you don't need. This isn't about just paying less tax. It's still about managing your business well. Okay. But it is a good idea if you have got profit in your business and you want to reduce your profitability for tax purposes, to go buy that little asset that you have been planning to buy for the last few years before the financial year end. Okay. So that's depreciation and interest. So let's look at our operating expenses. So obviously, the more we spend, the less profit we make, the less tax we pay. Now, I'm always so worried to say to small business owners, go and spend lots of money so that you don't have to pay tax. That's not the purpose, okay? The purpose is to say, what can we do with our operating expenses within the limits of what our business can afford so that we are still running a good business, but that we are tax efficient, okay? So we're not avoiding tax, we're being efficient in how we allocate our expenditure. So just to illustrate, if we took 40,000 Rand operating expenses and we increased that by 2,000 Rand, in this example, this business would now be 0 Rand profit. So there would be no payment due to SARS. Okay. Now, that 2,000 Rand, did it just willy-nilly appear? Did we just find invoices and allocate it to the business? No. And we definitely didn't just go and spend a whole bunch of 2,000 Rand on rubbish so that we can pay less tax. Okay, please don't do that. However, if you are good about keeping your records, about keeping all the slippies, all the invoices, making sure that you keep track of all the expenditures that you incur, I promise you that you are probably losing out on a few things here and there, which could be the difference between, ish, I've got to have to pay tax here, or I'm just making it, I don't have to pay tax. So let's have a look at what we can do legally. Okay. I'm sure that you are all aware that if you operate your business from your home, you are allowed to deduct home office expenses. We'll dig into that a little bit in a moment. So we'll look at home office expense management. And then, as I said, keep all invoices and slippies for the business or what you know is business expenditure. But when you own your own business, you also want to keep all your personal expenditure, because you never know which of those would be a relevant and a avoidable, tax avoidable expense. Let me put it that way. Okay. So these are our typical business expenses, and this is what we would deduct every month: accounting, advertising, bank charges, blah, 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 blah. Okay. So all of these will be deducted anyway. So make sure that you keep every little invoice, every little slip, so that you can deduct it and that you have the evidence if you were ever to be audited. Let's talk about home office costs, because I know a lot of you manage your businesses from your homes, your garages, your backyards, your bakkies, wherever. So SARS is very clear on home office costs. The idea is that any costs that you incur for your business is deductible, whether it happens in your house or whether it happens on a rented property, okay? So any of these costs that would typically, if I was just living in my house and I wasn't working from my house, I would still be paying. Okay, Wi-Fi, cleaning, electricity, insurance is actually relevant, rent, repairs and maintenance, staff refreshments, welfare, all of those things are home office costs that you're incurring anyway. So how much of what I'm spending in my house can I deduct as a tax deductible expense in my business? So the rule of thumb is that, strictly speaking, you should calculate the amount of space, floor space, that you use, and then apply that percentage to the cost of all the other costs. So say, for example, I've got a 200 square meter home. My garage is 36 square meters. 36 is 18% of my full home. So I run my business out of my garage, okay? 18% of my house's space I'm using for business space. This then means that 18% of my home costs can be deducted as business expenses, okay? Meaning that 18% of the cost of cleaning, maybe I have a cleaner that actually works in the house, but because she cleans everywhere, she can then, that cost can be deducted in my business. 18% of the water and lights that is used in my house can be deducted as part of the business. 18% of repairs and maintenance that is used in the house can be deducted in the business, okay? So this is strictly speaking. As a rule of thumb, if you were to be audited and it would be hard for you to prove that this is the space I use for the business, maybe you park cars in the garden, there's a whole bunch of stuff that you've got to, you store stuff in cupboards in your children's rooms, whatever the case is. More than 30% of your house's space and your house's cost would start to become a little bit frowny. And when I talk frowny, if those expenditure items are more than 30% of your household expenditure that you're deducting for your business, SARS might start asking questions. So strictly speaking, you can deduct the space that you use as a percentage of your house. You can deduct that percentage of all the other expenses that you incur in your home that can apply to your business. Okay. if you're deducting home office costs, and your home office, and I wish you could see my face because I'm doing inverted commas, your home office is your laptop on the dining room table. That doesn't count. Okay, you actually have to have a dedicated space. If you've got the laptop on the dining room table and SARS were to come and audit, you would probably get into trouble. Okay, so that's a relevant tax deductible expense. You'll see here I've got a column with a whole bunch of question marks. So I spoke to someone the other day. They have a restaurant on a small holding that they own, and they actually deduct their dog, the cost of their dogs and the dog food as part of their security budget. And they have been audited and SARS was okay with it. So I put question marks there, but it is possible to, if you can justify it. Okay, so I think the rule of thumb always is just like I said earlier, is it relevant to your business? Is it justifiable? And is it true? Okay. At the beginning of the year, you have to go spend a whole bunch of money on your kids' stationery. And I put it under the question marks because I don't want to get into trouble, or I don't want SARS to come and audit me. But there are arguments to be made for the fact that I spent a whole bunch of money on stationery. Can I deduct that as a business expense? This one's borderline because how do you prove it? Okay, you've got the invoice, but how do you prove that you needed crayons for your business? So you can do it, but if you get audited, questions are going to be asked. The other thing that I didn't list on this list is something like parking. So every time you go to park somewhere, you pay money, take the slip. Okay, parking is a tax deductible expense and there's VAT attached to that. So the more VAT you collect on expenditure, the more you can deduct and the less you pay in your business. Okay, we're running out of time. I can't believe how quickly it goes. So I quickly want to just show you something in terms of personal tax versus business tax. So please have a look for me at the left-hand side. So we've got our typical business here. Operating expenses is 40,000. This business has got salary, telephone 2, refreshments 2, fuel 7.2, salary 25.5. I just thumbs-sucked a number, so please don't hold me to this PAYE number, but 4,000 Rand PAYE, which leaves us with 1,000 Rand profit. Okay, so the business is going to pay tax on 1,000 Rand. The owner of this business is paying personal tax, PAYE, on 25,500 Rand. What one can do in your business is actually reduce your own salary by allocating expenditure that you incur in your own, from your own salary into your business. Again, relevant and true expenditure. So instead of you can deduct a portion of your telephone account to the business. So instead of paying 2,000 Rand, the business pays 3,000 Rand. Instead of paying refreshments, the business pays 3,500, coffee, tea, sugar that you go buy from Macro, okay? Fuel and travel costs, maybe the parking and all the little extras. So what are we doing? We're increasing these expenditures. So instead of me, the owner, drawing the money out, the business is paying for those expenditures from the business's account. That makes my income less. So my income is 4,000 Rand less because I've allocated it to the business. That means I earn less, I pay less PAYE tax, okay? What it does do, however, is it increases the profitability of the business. So this is a bit of a catch-22. Do you want to pay more tax? Or does the business want to pay more tax? And this is a calculation you need to go and do and have a look which one will be the most relevant for you. But as a rule of thumb, it is actually a little bit easier or more tax efficient to reduce your own salary, your own drawings, pay the expenditure through the business. Business might make slightly more profit, but it reduces this personal income and tax that you have to pay. Okay. So before you go and do all this stuff and crook the books, here's a few rules. Can I justify it as a business expense? If you were to be audited, Can you show SARS that I was here on that day and I needed this thing for my business? Okay. Do I have the evidence? So do I have an invoice? Do I have a slip? Can I prove that I stayed in Tsitsikamma for 4 days because of a business thing? Okay, so you can deduct travel and accommodation to your heart's content, but can you justify it as a business expense, and do you have the evidence? Does it fall into the realm of average business practice? In other words, the moment the Afrikaans have such a good saying, they say, moenie die dam onder die eend uitdruk nie. The moment you become too much, or you deduct too much, questions are going to be asked. So whatever you are doing, does it fall into the realm of average business practice? Your household expenditure as a business expense, no more than the space that you're actually using, or no more than 30%. If you never show a profit, you've been operating for 20 years and never has your business showed a profit, questions are going to start being asked, guys. So make sure that at some point your business should be showing a profit. Otherwise, how the hell are you still operating? Okay. So that average business profit. And then the question you have to ask yourself is, am I taking a fat chance? And if your answer to that is, probably am, then you probably shouldn't be doing it. That's where I'm going to end. Thank you very much, guys. Have a good day.